Inflation came in hotter than expected, and that has hit equities and it has hit bonds. We do see gold, silver, and Bitcoin higher. We're going to talk a little bit about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mike, where I'm going to be taking some movements. So I'm just going to read this off here. He says, we are now in the riskiest period for inflation policy since the early Biden administration. Even without tariffs, immigration restrictions, deficit bloat, and attacks on the Fed, there would be serious grounds for inflation worry. This is probably the most sensitive moment we've had for an escalation in inflation since the policy errors of 2021 that set off the significant inflation that we had. It is not a probability, but there's a very real possibility at this point that the next Fed move is going to be upwards on interest rates rather than downwards. So that is the backdrop for the activity that you saw today. Not that any of you missed this. Of course, he speaks, and I don't know whether I mentioned this particular portion, but yes, he is talking a little bit about the deficit bloat. The deficit is something that I've been talking about a lot on the channel lately, just because obviously we have this DOGE thing, the Department of Government Efficiency, and all of the controversy that surrounds that, and trying to give people a perspective on how much waste, abuse, and fraud there might be in the budget, because if there was anything that one might choose to try to eliminate from the federal budget so that you could reduce the deficit, so that you could also then reduce inflation, which is sort of that invisible tax that lands on everybody, I like to try to put things into some sort of digestible perspective. And this I thought was rather interesting. And that is that ignoring what the White House has said, ignoring what the Department of Government Efficiency, which is, the mouthpiece for whom is really, and the creator of which is really Elon Musk. So just using the government's own data, conservatively, we're looking at annual fraud of 233 to 521 billion. And that is just fraud, by the way. According to the GAO, they're only speaking of fraud in that. Now, there can be some overlap when we also talk about improper payment. So an improper payment could either be for fraud or it could be for other reasons, overcharges, double payments, and all kinds of things like that. That's another $230 billion or so. But I think we can reasonably, if we just pick a middle number, we're in the $500 to $600 billion a year range. And that's Congress's own estimates. Now, why is this important? I thought this was kind of an interesting statistic. So it might surprise people to know that that is about the same amount of money as the bottom 90% of income tax filers in the United States pay each year. So there's about 160 plus million people who file taxes. Of those, about 107 million or so, as of the last data I saw, actually owe money. But, just think about that. So 160 to 170 million tax returns go in. They're carried often by mail carriers. There are 260,000 plus tax preparers in the country who are helping these people out. And there's over 80,000 employees at the IRS. And 90% of those tax returns are going to collect revenue that will go straight out the door to fraud. That seems like a tremendous waste of all of the labor of those payers. That is non-productive use of the 260,000 plus tax preparers. It is non-productive use for the people that work at the IRS processing all of those returns, only for that money to go into the government and out to somebody who's not supposed to receive it. That is kind of an astonishing way, at least for me, that was astonishing. I don't know if that's helpful for any of you to sort of get some sense of the scale and scope of the problem and why these things are so important. and why all of the partisan bickering and finger pointing and who's trustworthy and who's not. This is one of those things where, everybody needs to have, as, it's sometimes been said, needs to have a come to Jesus moment about all of this and really, really sort it out. And I've been paying more attention to it myself because I've been working on our own taxes. In fact, our printer quit in the course of that, which is the reason there's a brand new one sitting on the floor behind me, which I haven't had time to hook up and replace the one that's already here that's not working. All for that. So this plays into all of this on the inflation front, right? Because if we were able to eliminate that spending, so you can think about it, it's a very simple sort of economics 101 concept. If you increase the supply of goods and services that people need, and if you reduce the demand, then the prices will go down. If you have people who are non-productive earning money, trying to get goods rather than using those hours to actually produce things, and you have people who aren't supposed to be getting government largesse who are and are spending it, so you have excess demand and reduced supply. So you can imagine that just converting that 500 billion, 600 billion plus of wasted resources more productively, that it would ultimately have an impact. Okay, so with that cheery start, I figured I would go ahead and take a couple questions here. So Ranjana Gupta asks, welcome back. Today I bought a Jan 2027 70 call on Next Era Energy. Let's bring this up. For $11, what do you think of my trade? Okay, so a couple things about that. I generally prefer when people are looking to make directional bets using options that they do so using longer dated options rather than buying something that is either has very little time to go until expiration, which has a very low probability of landing in the money. Actually, in the case of an at-the-money option, which the one you've chosen is, it would really be a coin toss. But we don't like to do a whole lot of coin toss trades. That doesn't really seem like such a great plan. The next question that you want to ask yourself, of course, is how reasonably priced are those options? And the answer to that question is found in the relationship between the implied volatility of the options that you bought and how much the underlying asset actually moves around. And if you're looking at my screen, here's your answer. So right now, the 60-day realized volatility for Next Era Energy is about 26. And the implied volatility for the at-the-money options that expire 2 years from today is about 26. This is a nice relationship. You're getting it for fair value, particularly when you consider that we would normally expect, or you can often expect, to pay a small volatility risk premium. What's the volatility risk premium? That's the difference between the implied volatility of an option and the realized volatility. And that volatility risk premium can exist for a couple of reasons, not the least of which is that in many cases, volatility is not constant. So you have those idiosyncratic events that get baked into those longer dated options. So you have an underlying volatility process. Let's just say for the sake of argument that Next Era Energy was 20 vol. And let's say that those things were still 26. Would those be overpriced? Well, not necessarily, because you might find that the thing trades at 100 vol every time they report earnings, and they report earnings 4 times a year. And maybe there's some other things that can contribute to volatility. And so the volatility that's in those long-dated options has to incorporate the underlying volatility process of the stock. In my hypothetical, that's 20. But in this case, actually, it's pretty much spot on where the stock is realizing. So that's fair value. So just as a simple way to answer your question, I do like it. And I think that's a way for a lot of people who are thinking about this too. Some people like to use in-the-money options when they go long-dated. So I think Jim Cramer talked about this a lot. It's one of his sort of favorite strategies. It isn't necessarily my favorite strategy, sometimes because when you're buying those deeper in-the-money options, they're going to trade at a higher implied volatility anyway. The other thing is because they have a higher delta, they behave a whole lot more like stock than something that's at the money or maybe just out of the money, so you don't get so much convexity. That is more like owning the stock and buying a very long dated put. But that's totally fine. Tucker D. Dog, hello from the snowy NE, New England, I assume. I'm hearing that it's snowy, or it's going to be snowy out there. So for you skiers on the East Coast, enjoy that. It's actually been pretty cold here in California, as it happens. We've woken up and there's been some frost. It does not snow in San Francisco. There were rumors that it had in the past. I've actually looked into this a little bit because I've seen snow on the neighboring mountains. The closest mountain to me is Mount Tamalpais, and I've seen snow up there once or twice, but we've never seen any snow down here. And I looked into it, and apparently there's no real formal record of it ever snowing in San Francisco proper. So I'm sure that on the East Bay or further north, it probably has. But close to the ocean as we are, or the bay more accurately, it's not really that common. All right, Bob, thoughts on Uber 80 May long calls for $6.50? Is it expensive? We've heard fast money and halftime traders talking with a price target of 100. So yeah, Uber, interesting case here. I believe, was it Bill Ackman? I think Bill Ackman. Oh, I just remember talking about this very recently. And I believe Bill Ackman has it as one of his core longs. He doesn't short stocks anymore, probably singed by that whole Herbalife business. But, this is an interesting situation because we have good top line growth. We have good bottom line growth. That's the net income line right down here. We have decent free cash flow growth right now. So where's oh, there it is. My trusty HP12C over here. By the way, I'm sure a lot of you think, what's with this anachronistic calculator business? Got my first HP12C when I first started trading options back in the mid-late 1990s. Everybody had one. They were programmable. This one's actually an HP12C Platinum, which means you can put in a few more lines of code. We don't really use it for options modeling, but we would be able to put in a couple of inputs. I want to say the HP12C Platinum is 137 lines of code, if memory serves. And it's interesting because I really like using it. Just the order of operations, if you use one of these things, you get used to the order of operations, and then going back to an old regular calculator like the TI's is very difficult because the order of operations is a little bit different. And you could get an app for this on your iPhone. So I had an early iPhone, and I got one of the HP12C apps. And I actually reached out to a guy named Peter Carr because I was trying to program an options model that we had previously, one of his models actually, from an HP12C into the HP12C app on my iPhone. And after squandering about 2.5 hours punching each line of code into the thing, I eventually figured out that the app was no good. So if anybody has heard of an HP12C Platinum app or other that works on these things, for anybody who's a computer nerd, calculator nerd, let me know. I haven't toyed with it since then. Peter Carr, by the way, is a famous person in the derivatives business. Professor, you can look him up. He sadly passed away before his time a couple years ago. Anyway, so with respect to Uber, so we're looking at $167 billion market capitalization. I'm going to ignore the revenues for now, but this looks like we're getting, we'll just call it 270 a share on 80. So 29, call it 30 times earnings. 30 times earnings with earnings growth that is north of 30%. So the short answer to this is yes. Risk factors here. The robotaxi is clearly a risk factor. I think I'd previously articulated, too, that I was a little bit concerned about what was going on with Cruise, because if Cruise was going to be, and actually I'm coming around to a different idea here, and that is that technology stack might ultimately be of beneficial, a tailwind of sorts for Uber. Why is that? Because if you lived in this area, you probably knew that Cruise, which was an affiliate of General Motors and is now being rolled into the parent company, was much like Waymo, operating fully autonomous robo-taxis here in San Francisco. I don't know whether they were operating anywhere else. I have a good close friend who worked for the company. I'm pretty sure he got laid off because they've laid off a lot of people. And when I first heard that, I thought, oh, that's not good for Uber and Lyft because they were going to rely on them for cars. But actually, there is a positive because they still have that technology stack. Presumably, they're going to incorporate it. They use it a lot. So General Motors Super Cruise, which is kind of their highest level of existing autonomous driving technology in the cars that you can buy every day, is better than a lot of those same autonomous features in other makes. So I've had two cars that had partial autonomous driving. Those were both BMWs. The first one was terrible. Actually one of our producers rode with me in that car from Austin, Texas to Dallas. At one point, a subsequent one was much, much better. And of course, we've had a couple Teslas. Their full self-driving technology is scary good. But my point is that to the extent that a company like General Motors might actually have this kind of technology, that could ultimately prove to be beneficial for Uber. The other thing is that Uber has other features, other delivery features, and like Uber Eats and things like that. So I think this right now this looks really good. Tesla Robotaxi is a threat. Waymo is a threat. But those are not making money right now. And Uber is, and they're growing fast, and they've got really respectable cash flow. I mean, take a look at the cash flow. Actually, I think people should probably pay more attention to that kind of thing. So if you take a look out at $8 billion on 2025, and I'll round up and call it 170. So that's almost a 5% free cash flow yield. And for this year, the year we're currently in, and it's looking like it's going to be 25% better than that next year. So you're looking at that's 6% free cash flow yield on 2026 numbers. It's pretty solid. So yeah, I'm with you. Hi, Mike. Can you explain what has happened recently to gold prices and the apparent run on the Bank of England gold supply? Okay, so, there's a couple things going on here. And probably most of you have heard this, but we are setting records for demand for physical delivery on the COMEX. So I had a seat on the New York Mercantile Exchange. So on the commodities side, some of you may or may not know that, all of these exchanges were kind of based in downtown lower New York City. If you've ever seen the movie Trading Places, which they were, that was the old New York Board of Trade. New York Board of Trade, the COMEX, and the NYMEX, all of these things effectively ended up getting merged, and they all ended up at World Financial Center. I was trading energy commodities, so natural gas, crude, the products, options on those more accurately. We also traded the E-mini futures and things like that, but we traded some of the other commodities upstairs, and that means it was a quick escalator ride, and you were on the COMEX, and that's where gold traded. So the thing is that most people who trade futures do so for two principal purposes: to speculate on the price or to hedge. And because that's their principal objective, most of the time, that open interest gets closed out before the expiration of those futures. This plays into some weird dynamics from time to time, and a really good example of that happened during the pandemic when crude it actually settled at a negative number. And people would say to themselves, well, how the heck can that happen? And what it has to do with is when the open interest isn't closed before those things mature, because these contracts are not just financial contracts. They settle to the underlying commodity. So, people will joke and they'll say, oh, well, you take delivery of oil and then you have to, have all of these barrels and you put it, where are you going to do? Put it in your driveway. Yeah, that's not how it works. So, in the case of the crude contracts, they settle to Cushing, Oklahoma. Now, what had happened there, and I'm gonna get to your gold in just a second, but I think it's kind of important to understand that physical delivery can play a very big role in the settlement price for the futures and for spot and so on. So for WTI, the delivery point is Cushing, Oklahoma. And it's a convenient spot. It's the middle of the country. It's a big oil patch, Oklahoma and Texas. You have pipelines that go into that area. And they have, in Cushing, Oklahoma, they have a massive amount of storage there, storage tanks. And those storage tanks, for what it's worth, of course, they have limited capacity. The pipelines themselves have limited processing capacity. And then the individual tanks, it's not like all crude is exactly the same. So WTI is a specific, it's not just that you are expected to either make or take delivery of a certain amount of crude. There's also a other set of specifications related to how sweet or sour it is. WTI, West Texas Intermediate, is a sweet grade. And so you can't put all those things into the same tanks. So what happened when crude traded negative, and this is a little sidebar before we get to what's going on with gold now, is that there was an exchange-traded product. It was like an ETF. And that fund was actually trading crude futures. So this is convenient for people who wanted to speculate on crude who weren't able to trade futures, weren't really familiar with the process, found it very scary. There's a lot of reasons why people who trade stocks wouldn't trade futures, so they could buy and sell this thing. We have U.S. oil fund. USO is an oil ETF, ETP. So there was an ETP that got long a lot, and there was a lot of retail money in it. And what ended up happening was, as expiration approached, they still held a massive amount of the open interest. And the amount of open interest that existed in the crude contracts at that time for, I think it was April delivery, if memory serves, and someone can probably get in my ear because we actually did a video about it way back then, actually exceeded the capacity at Cushing. In other words, if all of the open interest in the futures didn't get closed, so there might actually, if you go onto the channel, you might find a video, this exact video about it. So how much oil is too much? And basically, if they didn't close that, everyone was then going to have to take physical delivery, and that was not possible. So since you could not take, there was no way to take delivery because it exceeded the capacity, you would have had to have paid so much, even if it were possible, which wasn't really, that people had to close. And that meant that you could have bought crude futures at $30 a barrel, and then you had to pay to close them out. So you could buy oil at $30 a barrel, and you could lose 50, as unbelievable as that sounds. I'm trying to remember what the actual ultimate low settlement price was. Maybe someone can get my ear and remind me. But it was a really big number. So fast forward to today, COMEX, so gold is not quite like crude because you don't need a tank necessarily, but still the delivery is specification and location dependent. And the interesting thing that's going on right now is that normally in that market, the expectation is, and this is just one of the factors going on, the expectation is that people speculate with the futures and you typically roll them. But what's actually going on right now is that there seems to be a really high demand for the physical metal. People are buying the futures, and when maturity comes, they're saying, you know what? I don't want a financial contract anymore. I want the real stuff. And typically, one of the reasons that gold futures trade in contango is because it delivers to the physical metal. But if you have futures that expire 2 years from now that deliver to the physical metal, what is it that you don't have to do for the next 2 years? You do not have to store it. You do not have to insure it. All of those kinds of things. But the problem is that if the demand for, imagine what the futures curve looks like, and then imagine that the demand for physical gold exceeds the immediate supply. What do you start getting into? You get into a situation where spot gold prices start to rise. And, it has sort of, there's a little bit of a conflagration going on. That's not the only factor, though, right? So if You also are seeing evidence that gold is commonly thought of as an inflation hedge. If people think that inflation is going higher, they might want to own more gold. If people are concerned about quantum computing blowing up Bitcoin, and I'm not saying that's what's going to happen, but I'm just saying that there's one or two people out there who do believe this. You've probably read that. They think, well, you know, maybe a little bit of gold isn't a bad thing. Or maybe people think we're having a constitutional crisis. Constitutional crisis doesn't usually turn out so hot, so I'm not so interested in dollars. I'd be more interested in having gold and silver. So there's a lot of potential reasons that it would go higher. For me, the principal reason, the most important reason at the moment, because I'm not quite as panicky about those other issues, would almost certainly have to be just inflation concerns and demand for the physical playing into it. So that's what I have to say about that. Actually, I don't know if I put that up on the screen. If I didn't, I apologize. Okay, PC, when selling a strangle using the implied move, what to do under, excuse me for a second, I have a little stand here that holds something. So when selling a strangle using the implied move, what to do under different scenarios after an earnings release when the stock moves more than the implied? Excellent question. PC, did you have a specific example? You know, maybe we could take a look at one. Hood earnings just came out, right? And I think they came out, and it was pretty good. How much did the stock move? Well, not. That probably would have been a good one to sell, I guess, right? Did their numbers come out? Maybe someone can get my ear and tell me. Did that come out before or after the close? I thought I was looking at this during the day, out of the corner of my eye. I believe we got these numbers during the day, and it was a big, strong beat. Okay, so that's not a great example, though, because it didn't really move. I'm sure that $3 is not hugely outside the move. So let's just quickly take a look at some earnings releases. Maybe I can find one from today. Hood was up. Oh, Hood's up 10% after hours. Perfect. Thank you, for providing that. Okay. So let's take a look. What was Hood implying? Yep. We had to reboot this machine right before we got started, so I did not have this handy dandy cool tool to take a look at, which we can now do. So we just go, let's see here, go into Ticker Explorer. We can go to, oops, where did I go? Earnings. And let's have a look at Hood and see what we got. So the implied, oh, it was right now. It's right on the implied move. Actually, it was implying about 10. So it looks like it. I guess we're gonna see. But look, what difference does it make? We can use this as an example. All right. So let's just take a look at this. Up 10%. So let's see where the stock is. $62. Perfect. Okay. One other quick thing was that you didn't say, so PC, this would be helpful just to know, because this will matter, what the tenor of your options position or the hypothetical options position is that you're talking about, right? Because if it's, let's say for the sake of argument that you had sold the strangle on Hood that expires on Friday, right? So now you've got 2 trading days left. And let me just expand this so we can take a look. So stock's trading $62.50. So let's just say, and the implied move, what did I say it was? About 10%. Stock closed 56. So that's going to be $5.50 up. So, well, it's going to be very close to the touch, or maybe it went slightly through your short call strike. But if you're in that circumstance, there isn't that much to do. The first thing I would say is that tomorrow morning, the downside of the implied move which if we call it 56, so we're just going to say it's down, you know, to $50. So let's say you were short the 50 put. Those 50 puts are going to be, you know, essentially worthless. So you can just cover those, and you might as well. Some people like to ride them in, but I don't think that that's very capital efficient, and weird stuff happens. So I've always made it a habit to close teeny options. I'm just not interested in being short insurance on an underlying asset, you know, for some tiny infinitesimal fraction. You know, let's say you could cover those things for a nickel or something like that. You know, why wouldn't you? You know, it's 0.1%. Now, you could say, oh, but it's 0.1% over 2 days, right? Okay, you know, so 0.1% over 2 days, you could say that, you know, that works out to whatever, 18% annualized. Yeah. But that's not really the way to think about it, because the amount that you can make on that individual trade relative to the amount you can lose is, you know, it's nothing. So I would probably cover the short put in a case like that if it was a one-day option. Now, different situation if it's not a one-week option. What if it was, say, a 6-week option? Let's just say it was March regulars. You know, that's pretty close to that amount. So now you're going to have a slightly different situation. The first thing that you have is that there is going to be a volatility crush. So the good news is that while the call that you're short is going to go up in value because of delta, it is going to go down in value in terms of vega. How much? Well, let's take a quick peek. We can actually just take a look at the behavior. And actually, I can probably... Whoops. What happened here? Did I just lose my unusual whales? Where is that? Did I close it? Sorry about that. Oh, here we are. Okay. So, we're interested in knowing, well, how much will volatility potentially drop? Well, we can actually take a look at how implied volatility changed in history over similar periods. Okay, so I'm just going to get rid of the stock price because that's not really the relevant thing that I'm interested in. So you can see here, this is realized volatility. You have these big spikes, and then you have implied volatility, right? So if implied volatility here, and we'll take a look at what it actually is, but we can see that here, you know, going back to summer of last year, implied vol went from 87 down to, call it, 50. Okay. So that means that implied volatility, and then we're just, you know, back of the napkin, down 40% or something like that. Okay. So as we go back to the value of that specific option, we can now say, all right, well, what's that option likely to be worth? So we'll just take a look at that option right now. That was the, I think I was looking at the 62 strike calls. Those were about 80 vol. So I'm going to just assume, you know, maybe that comes in by a similar amount. So that's going to be, you know, 46 vol. Let's not be quite so ambitious. I'll just call it 50. And we're going to say that the stock is $62. So that's now a $4 option. Okay. I realize it's not trading, but you know, that's about where you're at. Assuming that my prediction on how volatility is going to, it's not probably going to be, oh, but that's another good point actually, now that I think about it. It may not go there instantly. It will go there quickly. And the reason for that is that the market making community is going to, you know, they're going to sort of feel out the flow a little bit. A lot will get sucked out. All of it, it's probably going to fall off a cliff, and then it's kind of like going off the head wall when you're skiing, and then, you know, it starts to ramp down as you get closer to the bottom of the hill. So you're going to experience that. But you know, one of the things you could certainly do at that point, if you were interested in doing it, is there's two things. One is you could roll up the short put side, because realized volatility is going to be less. The stock is not likely to move as sharply when news is already out, as it will when that news is released. I'm sure that makes intuitive sense. And you could potentially roll that other strike higher, or you could just close the whole thing. So those are, you know, 3 things that you could do. And you might actually consider rolling the whole structure out and up. Now, I know that the guys at Tasty, actually I don't know what the guys at Tasty would do, but I have a sense that their general recommendation is to adjust the untouched, untested strike, right? So if you were in a 50-62 strangle, then, and actually it would be the 65 or even higher one probably here, you know, then you could just roll the whole package out and up if you wanted to. And what that will do is it's going to sort of normalize the delta of the whole package. PC, the stock was Generac. Oh, okay. Here, oh, all right, well, so there we go. We're gonna actually deal with the specifics. Sorry, if I'd been looking over there, I probably would have seen this. So that's, oh, Feb 28, so very near dated, I gotcha. Let's see. Okay, let's see what we have. You had the 150 call, 130 put. Was that? I'm curious. Was that? I wonder. I don't know what the delta was of that offhand. Were those 20 delta options, or not? But yeah, I think the short version is that you can adjust the untested strike. The thing is, yours are short dated, so I would be more inclined to close those and roll out. And I'm going to say out and up, but actually, if I have a 20 delta strangle on, and so I'm selling a 20 delta strangle that expires in 2 weeks. Those strikes are going to be much closer to spot than a 20 delta strangle that goes out 2 months. So, you know, you're giving yourself a little bit more wiggle room when you go out a little bit further in time, and you're saying it's 60% chance that you get away with that strangle, but that's 60% over a longer period of time. So just look, I mean, it is what it is, and it's the 150 calls. The stock's up $10. It's 152, so that's not a terrible trade. You know, I don't want to suggest it's a terrible trade, but getting short, really short dated premium going into an event, and this is the thing that I think I've spoken about pretty frequently, which is that, and this is kind of the nuance, which is I don't really like getting short the move. You know, that's really a coin flip. It's unless the implied move is just off the charts, and I just can't see how a stock could move much more than that. My inclination is in general not to sell too much premium right to the event. And you know, here you're looking at an earnings that's on the 12th and options that expire 16 calendar days later. And I'm sure this is, you know, it's $2.50 in the money. It's not the end of the world. I don't know what you got for it, but I would get out. Oh, you're also saying that you're long May. Not super. When's their next earnings? Oh, you're long May, so you caught the next one. Oh, all right. So that's actually, you're probably up money, right? That should be up money. I mean, I didn't actually look at it, but you know, the way the stock behaved. What's the ideal situation in a calendar spread? You know, you want it to run to your short strike, typically. That's the best possible outcome if the short side is really short dated, which this one is. So I would still probably adjust it because, you know, now you're just short a ton of gamma. But yeah, you know, out and out. How about like that? That's one way to describe it. Like you go further out in time and out in strikes because that's going to get you to about 20 delta on that side. And I like what you've done by being long that longer dated one. Just keep in mind that as May approaches, you're probably, if you do that and you say sell something near dated, like March regulars on the 21st and then April, just bear in mind that what's going to happen is the implied volatility of the maze is going to sort of stay static and then rise a bit, and then it's going to get hit by the same vol crush that we've been talking about after the event. So just keep that in mind. That probably should be adjusted before then, right? So then you want to take the whole package and swing it out a little bit more, if that's your inclination. Okay. Sorry, I was looking back and forth, and that just took me a little bit. Corey Henderson, Palantir, stock has gone crazy. Sure has gone crazy. I have a covered call. Anyway, you can see who is buying this, retail versus institutional, U.S. versus outside. So, I'm in a bad habit here. I'm closing or moving windows I should not be. So let's have a look. Now, I think this is kind of important to remember, is that when you take a look at who's buying, so there's a couple things you can do. So in real time, what most people do to try to figure out who's buying or selling a stock is they'll do something like they'll look at the 13 Fs. And I brought this screen up before, so I'm going to bring up my Bloomberg one first. But the issue is that the 13 Fs, they tell you some things, but maybe it's there was an old joke, I don't remember who said it, but it was bikini is kind of like bikinis. What they don't reveal is more important than what they do reveal, I think was the way that old joke went. So if you're looking at Palantir and you take a look at all the big holders, all these big holders, some of these are what we call real money accounts. The real money accounts are like the actively managed mutual funds. So that's huge sums, but actively managed. Then you have all the passive stuff. The passive stuff, so Vanguard, top of the list here. Vanguard, that's passive money. They run ETFs. BlackRock, yeah, same thing. State Street, same thing. Peter Thiel, founder, not going anywhere. Geode, okay, so now we're looking at somebody that matters a little bit more. And we can see, they own 52 million shares, which is a big, big piece. That by itself is $5.5 billion. And they added 4.1 million. But the thing is, this is as of their most recent 13F filing date, which was the end of December, and we're 6 weeks removed from this. So I feel like looking at the filings, while it's helpful, I can do something like this, and you can do this in unusual whales too. Who's adding the most? The biggest adds are Invesco, State Street, Voya. That's also going to be pretty passive money. You can also look at that stuff in here. Did I have Palantir? I've got Palantir, yeah. So you can see the whole. This I think is sometimes more interesting, is looking at things like the holder transactions. So here you can see the insiders who are buying and selling. I think that's sometimes helpful. I use this more in the following sense, that if I see a lot of insiders selling, that's not generally a positive. This is kind of cool, by the way. You can sort of see. One quick point. This is really important, and actually so you might not notice this if you don't have an application that tells you both of these things. You will see purchases at times, but it's important to understand if those purchases are open market purchases or are the result of somebody exercising options. So here you can see that, right? So if you say, somebody exercised their options in the stock, that's a positive. Well, actually no, because they can't sell their employee stock options, but they can sell the shares in the open market. So if somebody exercises the shares, they're almost always turning around and selling them. That's why you get these kinds of things, right? So you see green and red. Is that an offset? No, not the way to look at it. So that's something else. So what's another way that you can see whether it's retail or institutional? Another way you can do that is by looking at time and sales. Now, I realize we're getting a little into the weeds here, but I can take a look at the stock and say, all right, well, and this is all in 100 lots. So that's one share. This 6 is 600 shares, and so on. This is, 1,000 lot. You're now talking about $117,000 clip. So now you're dealing with at least high net, right? Or even maybe ultra high net. So you can start doing something like this and saying, okay, what were the big blocks? Now, if you're looking at this, and I realize this is probably not that easy to divine. Let's see if I can make this a little bigger. Okay. So this stuff over here on the right, these are what we call condition codes. When a trader prints securities to the tape, they usually have to describe the nature of the trade in some way. What are some of the things that you could see in here? One of them is whether or not it's a net trade. And what's a net trade? A net trade is when a hedge fund or a mutual fund calls an institutional desk at an investment bank and says, I want to buy 50,000 shares of Palantir. Where do you sell it to me? And the bank says, I'll sell you 50 at a half, meaning 117,050 cents. Okay. Now the way that's going to show up on the tape is there's a regulation that you have to satisfy the lit market first. Reg NMS. So basically what that means is that if I'm the trader, then I have to lift it street side until it's basically at the price where I intend to print. So I don't have a depth of order right now. We can see that there's 100 offered at 42 cents as of the close, but let's just say that there was 5,300 shares between 117.42 and a half. So I would then satisfy those by lifting those off the screens, and then I would capital commit on the balance and print it to the tape. And because I'm charging a markup, let's say, to do that, I have to print it as a net trade. Some of these other codes that you see here, like R6, when I was trading, R6 was a really common label for me to put on trades, because an R6 label means that the stock print was contingent on something else. And it was therefore exempt from the rule I just described to you. So in that case, I don't have to satisfy the street side trades because those street side participants were not a party to whatever the contingency was. This will sometimes be reflected as, so the different labels, if you learn to read how these things go, you will see things like derivatively priced. That would be an example of a contingent trade. There are other types of orders that somebody could have given you at the beginning of the day. So you have a working order and then you print it. So that's another type of thing where you ultimately end up printing it. And R6 derivatively priced. What that means is that I can trade outside of the lit market. And here we're seeing that it actually traded, this one is R6. It's trades 117.39, which is dead on the closing price. So that's fine. Oh, these are actually after the close. I should probably, let's take a look at something inside of regular trading hours. Probably a little bit more helpful. Okay. So it's trading in this neighborhood then. So these are all bigger trades, and let's see just how big they get. So, $1 million transacting in this thing is going to be, we're going to look at, call it 8,000 shares or something like that. So here are some of the big trades, right? So there is some big prints going up. The ones that say R6, I don't really think about those so much. If I see upticks on good size volume, those are institutional buyers. I don't know who. I just know that it's not retail. And if I see that I see that it was a net trade, that's almost certainly not retail either, because only institutional traders have relationships with capital committing desks. So that's going to be one trader picks up another. Where do you show me? So that's a way that you can look at. what I'm trying to give you here are things that you can look at in real time. If you say, okay, well, I'm looking at a narrow window, we can narrow this window up considerably. I'm looking at a narrow window of time and I see a lot of shares trading. How much of it was retail? I'm looking, this is all of the trades that were more than 8,000 shares or $1 million in a block print that took place between 340 and 345 today. So no one's going to give, leakage is a really big thing amongst institutions. This is the reason why there are black pools, dark pools and gray pools. Essentially what's going on here in a dark pool is it is a way for big institutional participants to meet and transact without anybody ever really knowing what's going on. And those things are actually kind of interesting because the way those work is that institutional interest drops your interest in to the dark pool, and two participants might pair off immediately. So I have 50,000 to buy, somebody else has 50,000 to sell, and we're both sitting in the dark pool together, but the dark pool does not necessarily fire the trade in straight away. And the reason is because you can imagine that would be a form of leakage too. Imagine, okay, just think about this for a second. Imagine if I'm a big size buyer of Palantir. Okay, so I want to buy 100,000 shares of it. Okay, so $12 million worth of the stock. And I'm going to start buying it in blocks. So I drop 25,000 into a dark pool. If I put 25,000 in and bang, I get hit immediately, what do I know? I know that there was a resting seller out there. Now, if the dark pool instead randomizes how that trade takes place, neither the buyer nor the seller is going to really be sure who got there first. So leakage protection for institutional traders is a hugely important thing. And I'm being told I skipped over something. What did I skip over? I can't see this. I can't see. What did I skip? Oh yeah, okay, I'll get to that. So, yeah, you can look at the 13 Fs. You can read the tape a little bit, try to see what's going on. I think all of those things are helpful at the end of the day. Trite to say it, but look, if the stock keeps trading higher and there are prints big and small on balance, there are more buyers. I'm not trying to be glib, but that's kind of the way to think about it. Fluor will report next Tuesday. Time to expect a rebound. Thinking of buying the March 45 calls, selling the 50s, roll short after earnings. So it's interesting because Fluor was one of those names, and if you've been watching this live stream for a while, you will know I've talked about this stock in the past. One of the reasons that I talked about Fluor, for those who don't know, there are these engineering, construction types of companies. Fluor is one of these. This is one of those companies that, in addition to other things, has expertise in the nuclear reactor space. I expect nuclear generation construction to take place. And that's in addition to decommissioning, recommissioning, maintenance projects, things like that. So I kind of feel like I do like their business. I also feel like it has not been particularly well loved of late. They have, this is a more cyclical business. So when you take a look at it, you kind of have to say, all right, well, which part of the cycle are we in? But, generally I'm pretty positive on it. So let's take a look at the implied move, see whether the options are pricey or not going into it. Moves an average of 6.4%. And so today it's going to be reporting in 6 days. And we're really interested in the straddle that expires in 9 days. So let's just take a look. So we'll go from -6 to +3. Average move is 8.5%. Next week's options are pricing a move of, actually it's not next week because this doesn't have weeklies. 46, 47, we'll call it 46. The straddle is priced at close to $5, 475 maybe, 480, so 10%. Okay. Yeah, I think you do want to use a spread. I like that because it right now it's implying a move of about 10%, and that's little. That's maybe a little bit on the high side. I actually have to adjust what I had here though because I had -6 and it's I don't need to go at 3. I need to go at 10. Yeah, so it's right about fair value on the option side for a comparable amount of time. So what am I doing? I'm just saying, okay, well, over the last decade or so, if I was buying options 6 days prior and going to hold them until 10 days after, what kind of moves might I commonly expect? Now, an average, saying that I expect it just because that's the average, well, that's not really all that thoughtful, is it? Because, something could average at 10%. That could be 9 times where it didn't move at all, and 1 time it moves 100. So that's not really but you can take a look actually and see, what's going on. Recently, it's been a lot more quiet, and that also, by the way, the fact that it's been more quiet recently is one of the reasons why I'd be more inclined to use a spread. Maybe you get a good pop out of it, but it just hasn't been behaving particularly well. Now, this is also because it hasn't been behaving particularly well and it's been underperforming the market for a longer time. This is a situation where actually you may be interested to take a look at the 13Fs because you're trying to figure out what the big money players are doing over a more extended period of time. So, here we can see, and these are, I'm not going to call them all fast money accounts, but 0.72, formerly known as SAC, that's kind of fast money, right? Millennium, it's a hedge fund, fast money. Jane Street, don't worry about that. That's a market maker. But Rubric and some of these others, the banks, especially some of these, like Bank of New York, Custodian Bank, that's not fast money. Cube, that is fast money. So we've got a couple fast money sellers on the institutional side. What do we have on the buy side here? It's a fairly even mix. Fairly even mix. Okay, hope that helps. All righty. So that was Fleur. Forgive me, I'm just going to work my way up this list. We got to Uber. We talked about gold. We talked about strangles. We talked about Fleur. We talked about Palantir. I believe that markets are efficient, so it is a waste of time for me to pursue a dividend capture strategy where I enter buy rights to capture dividends. So here's the thing. Markets are efficient, especially around things like dividends. Here's the problem with this. So the buy right strategy. So just for everybody's edification, what's going on here? Buying a stock right before it goes ex-dividend is not a source of alpha. Let's start with that, okay? But when you introduce options into the equation, things get a little bit different. So first of all, why is there no benefit? The reason is because when a stock goes ex-dividend, its stock price will, all else equal, fall by the amount of the dividend paid. So you don't get something for nothing. So a $100 stock, it's about to pay a $1 dividend, does it 4 times a year, so it pays a 4% dividend yield. That would be very juicy, but let's just use it as a hypothetical. Stock's trading 100 prior to the X date. All else equal, I expect it to be trading $99 the day it goes X, because that stock is worth less. How much less? $1. Because if you'd owned it yesterday, you'd get the dividend, and if you got it today, you don't. So there is no free lunch to be had on that. But the wrinkle that this question is asking actually relates to the fact that the stock price is going to decline to accommodate that dividend and you are short that call, and so somebody who's going to exercise it, they can't get the dividend. So this is an interesting thing, right? Because first of all, the call options, in the course of time, they incorporate the net present value of the dividend into the calculation. And what I mean by that is that all else equal, if a dividend goes up, the value of a put rises and the value of a call falls, commensurate with the net present value of the dividend that could be captured between now and the expiration date of the options. So some of that discount is baked in, but not all of it. And this is actually the reason why, if you are long, deep in the money calls right before an ex-dividend date, you really need to pay attention, because what may happen is the thing's just going to be trading to delta at this point, and the stock could fall, and you're just going to lose that money, whatever the amount of the dividend is. This is the reason why you see so much call activity right before a stock goes ex-dividend on in-the-money call options. Market makers are trying to get short those options because they're hoping that, I'm not going to say you, but just the world out there doesn't know this and either forgets to sell the call before it goes ex-div, or they forget to exercise it to capture the dividend. So if you're short calls and they're at at the money or barely in the money or out of the money, then yeah, you will find a little bit of edge. If you are short calls that go in the money, though, and you're hoping to capture that free dividend, don't count on it because the market making community is onto you. They know where the open interest is, and you will often see multiples of the open interest trade on the day prior to an ex-dividend date for options that should be exercised early in the hopes that they won't. So what you're going to find is you're going to get assigned in that instance. So just think about that. Net present value of the dividend exceeds the extrinsic value of the strike, which you can determine by taking a look at the corresponding put. So if you didn't mention what stock it is, or maybe you did you? So, I don't know that there's a really good investment strategy in there, net of transaction costs, and also the fact that you're selling puts and stocks to really generate some meaningful alpha. But I will say that if you are long a stock and you are short a call and it's about to go ex-dividend and the option is at the money or just out, or even slightly in, you might win. Even if it's deep in, maybe there's not enough open interest to have caught the attention of a market maker, I guess. You might get away with it, and that's found money, right? Who's complaining? In the market making crowd, by the way, back in the day when everybody actually stood on the floor, we would do these spreads, and we'd have to compare, because we were all competitors. I mean, enemies during the day and then friends at night kind of thing, because we're all working for competing firms. But the deal was that we would trade all of these with one another, and the way that the allocation works on assignment, it was very common for somebody to get away with more than they should have, right? So let's say there was 5,000 open interest, and somehow 1,000 of that wasn't resolved prior to the ex-dividend date, so we would trade 10,000 spreads to try to get away with it, which means that if we did that, mathematically you would expect to get away with 1 out of every 10. But inevitably, in a big crowd, there would always be one guy who's like, oh, I got away with 30% of them. And if it was in a stock like Philip Morris, a big dividend-paying stock, this could be real money, right? Does 1,000 spreads, gets away with 300, and it's a 45-cent dividend. Well, $13,000. Found money. That person would have to buy lunch for the crowd. That was the deal. Okay. Let's see what else we got. Baiju Bhatt sold options worth $5 million on February 7th in Hood, just before the company's fourth quarter earnings announcement. So just before the announcement, okay. That may have been part of a regular program. Generally speaking, insiders aren't supposed to be transacting in the stock right before a meaningful announcement about which they would have some potential insights. So, and oftentimes you have people who have these regular programs which they will describe as part of their estate or financial planning arrangement, and they're receiving awards and then they routinely dispose of them. So sometimes that's worth taking a look at, but other times it might just be part of one of those programs. It's worth finding out whether they had any comment about that. Looks like SPX SPY is range bound now, strangles. So here's the thing. When implied volatility rises, so let's just take a look at 2-month implied vol. So when you sell, you're selling the white line and you're buying the orange line. That's one way to think about it. So right now, I don't really see so the range bound thesis is strictly a technical bet. It's not a vol bet here because vol actually seems reasonably priced to me. It does feel like we're struggling a bit here. And we could get some good news, but this inflation thing, it is a bit of a headwind. The market, although the market, we have to admit, has been fairly resilient on a couple of fronts. So we had the AI trade swoon, and we kind of recovered from that. Now we've got, I would say for a hot inflation number, 16 handles in the S, that's a nothing burger, really. If you had asked me, in fact, it's interesting because I had been thinking, I was debating on Monday, like, oh, you know what? I kind of want to short the inflation print. And I was thinking about that, but I've been dealing with some other stuff, and I didn't actually put the trade on. I wanted to, sort of stew on it a little bit and take a look at some other contributing factors on the inflation front to see how things looked. Got distracted, didn't do it, and then I saw the number this morning. I was, oh, God. I wanted to just buy some short-dated SPX puts just as a short bet going into it. And that, by the way, is not a strategy I recommend, right? That's one of those, speculative flyer bets you make. This is not an investment strategy. It was just one of those things. Kind of had a feeling, but didn't act on it. And then I saw where the S&P was. I was like, geez, that was nothing. I mean, I would have absolutely expected it to be down more with a 20 basis points hot on the inflation print. It was actually, so CPI was 20 basis points hot. The X item, so X food energy, I think it was 10 basis points high. And I also think people had started to discount the rate cut. They've been pretty deliberate about it. Anyway, if it continues to chop around like this and you're making a strictly technical bet that the market's going to remain range bound, then sure, you want to sell 20 Delta strangles, go ahead. But I will tell you that on a vol basis, there's no edge in terms of vol. Not that I see, not at the moment. NDX. You were looking at NDX? Sorry. Let's take a look. Take a look here. Yeah, I mean, here too, again, you're selling the white line and you're buying the orange line on the hopes that the orange line is going to drop below the white line. That's effectively what you're doing, right? If you sell 17 vol when it's been realizing 19 over the course. Now, it's Iron Condor. Oh, okay. Well, actually, look, Iron Condor, same thing. Whether you're selling strangles or you're trading Iron Condors, so this trade, I will tell you that I probably would favor the Iron Condor a little bit more right now, because you know, you get more comfortable selling premium when you really feel like you're getting something for your money. You know, when you see a lot of edge. There's not a huge amount of edge here. So again, if you're playing a range-bound thesis, the nice thing about the iron condor, so that's selling a strangle and then buying a further out of the money one. The nice thing about doing that is that, you know, number one, you've constrained your risk. You've reduced your capital requirements materially. And also because you're not net short as many options. You know, you're short a put spread and a call spread, but it's not naked short a put, naked short a call. So your vol exposure is also less. So if vol pops, even if it remains range bound, but for whatever reason vol suddenly shoots up, that's a better spot to be. And this brings up another interesting point. If you see vol really high and you sell it, and implied vol comes in, your thesis remains the same, and it's basically been chopping around, you can then leg into or add that outer strangle at that point to put the hedges on and reduce your capital requirements, reduce your risk, because, you know, part of the edge that you thought you had in the trade, let's just say that for the, you know, sake of argument, let's just say implied vol 2 months out was 20 or 22, excuse me. So you see 2 points worth of theoretical edge just over trailing. And if we take a look over the last year and we just see what the average was, so we can think about that. So I'm just going to get some additional statistics in here. So average volatility over a comparable period of time is 18. So you're kind of thinking to yourself, I'm selling 22 to buy 18. I'm getting 4 clicks of vol. And then you're layering in that technical aspect, like you see support and resistance. If implied volatility falls to 18, you still believe in the technical thesis, and there's still some time to go to expiration, you could at that point say, you know what, now I'm making a bet that it's going to be range bound, so I'm going to cover the wings and buy that longer strangle. The further out of my strangle, excuse me. 15 delta, I mean, that's good. You have 70% probability of profit with that trade, though, right? For the iron condor or a strangle if you did either one. Okay, so we are way over an hour. I apologize for dragging you all through that, but I hope you found this helpful. And yeah, just, you know, I just want to come back to this thing. So 60 days from now or thereabouts, 2 months from now, you're going to be filing your taxes. And, you know, I don't know what side of the political aisle one happens to reside on, but I do think that this is one of the most remarkable times where there could really be an effort to come together. I'm not seeing much evidence of that. It seems like everybody's pointing fingers and insulting one another and all that kind of thing. But the fact is that it's really hard not to get behind this as an objective. Whatever it is you want to do with the nation's resources, you must protect them first. Because if they're out the door, you can't give it out in tax cuts, you can't give it to some other beneficiary. You gotta fix that. Got to fix it. So if you talk to your representative, encourage them to try to find a way to talk to their compadres across the aisle. See if they can't sort this out. Oh yeah, hit the like button. Appreciate it. Like, comments help too, I think. And tell your friends. Tell them to come join us. And you know, look, the more questions people ask, and if you get more people asking questions, then you're going to get input on what other people are thinking. And, you know, that's an important gauge of investor sentiment. So I encourage that too. Thanks for watching.